$2.9 trillion. That's how much capital has quietly left America in the last 36 months. Not speculation, not a conspiracy theory, not a viral tweet. Actual documented outflows tracked by global custodians, treasury reports, and cross-border settlement data. Money doesn't scream when it leaves. It slips out the back door silently. And that is exactly what happened while the public was busy arguing about elections, celebrity drama, and TikTok trends. Meanwhile, the biggest players in global finance, sovereign wealth funds, central banks, multinational institutions, made their move. A move that hasn't happened at this scale in over 100 years. And here's the disturbing part. Nobody in mainstream media explained why. Nobody connected the dots. Nobody told people what a $2.9 trillion outflow actually means. But once you see the pattern, once you understand the mathematical sequence behind every major decline of a world power, you've all realized we are not watching an economic event. We are watching a transfer of global dominance. And like every transfer before it in history, it begins with money quietly leaving the empire at the top. Most people don't understand what capital flow actually represents. They think money in markets moves like random waves, up and down without reason. But smart money, real smart money, moves for three reasons only: risk, return, or survival. And when $2.9 trillion leaves the most powerful, most liquid financial system on Earth, that is not about return. That is about survival. The insiders saw something the public did not. And the moment the pattern clicked, they acted. Here's what nobody explained. $2.9 trillion is not just a big number. It's the largest capital exodus out of the United States since the 1930s. Larger than the outflows during the dot-com crash, larger than the outflows during the 2008 financial crisis, larger than the outflows during the inflation spike of the 1970s. And if you think this is random, let me show you the pattern that every empire before America followed. The same four-stage cycle that destroyed the Spanish real, the Dutch guilder, the British pound. Every single one began with the quiet outflow phase, not the collapse, not the crisis, the outflow. Stage 3, the warning stage. America has entered that same phase. Let's start at the beginning, with the moment the shift became visible to anyone who knows how to read global settlement data. Mid-2023, foreign holdings of U.S. Treasuries peaked at $7.6 trillion. Today, it's down to $6.2 trillion. That's a $1.4 trillion reduction in foreign demand for U.S. debt. But that's just the visible part. Under the surface, something much bigger happened. Currency settlement data from SWIFT and SIPS shows a jaw-dropping decline in dollar-based transactions, down nearly 18% in 3 years. Meanwhile, yuan-based settlements have tripled. Not increased, tripled. And BRICS payment systems, once considered irrelevant, processed over $422 billion in cross-border trades last year. That's not a trend. That's a migration. Money moving from one financial ecosystem to another. But here's what makes this truly historic. This movement didn't begin with countries America considers adversaries. It began with allies. Japan, the largest foreign holder of U.S. Treasuries, reduced holdings by over $220 billion. South Korea diversified 18% of its reserves. Belgium, acting as a proxy hub for European custodians, cut another $65 billion. Even Switzerland reduced exposure. These aren't anti-dollar nations. These are America's closest partners. And they didn't announce anything. They just moved, quietly, step by step, month after month, the silent exodus. But the most alarming signal wasn't foreign governments. It was U.S. institutions themselves. BlackRock restructured global portfolios. Goldman Sachs lowered U.S. equity weightings for institutional clients. JP Morgan increased overseas positions. Bridgewater shifted strategies. And the Federal Reserve, America's own central bank, shrunk its balance sheet by over $1 trillion, letting bonds expire instead of reinvesting. If the people who created the money system are stepping back from it, what do they see coming? $2.9 trillion didn't leave America because investors hate the United States. It left because smart money can read mathematics faster than politicians can create narratives. And the math says something brutally simple. The U.S. is spending far more than it earns, borrowing more than it can repay, and printing more than it can control. When that equation breaks, capital flees. Always. Let me show you something no mainstream economist wants to explain. In the last 24 months, America added $4.3 trillion to its national debt. That's $180 billion per month, $41 billion per week, $6 billion per day, $250 million per hour. And here, it's the part that should terrify you. Over half of that new debt wasn't purchased by foreigners. It wasn't purchased by private investors. It was purchased by America itself through circular financing mechanisms that only appear in late-stage financial systems. When a country starts buying its own debt because nobody else wants it, that's not stability. That's the beginning of structural decline. Now combine that with rising interest payments, over $1 trillion per year, And you get the exact same conditions that triggered the downfall of Britain in 1976, the Netherlands in 1795, and Spain in 1596. Massive debt, falling foreign demand, rising interest costs, weakening currency settlement dominance, and then the silent exit begins. This is where we are. But here's the part nobody explained. $2.9 trillion exiting doesn't crash the system immediately. That's what makes stage 3 so deceptive. During the silent exodus phase, asset prices often look stable, even strong, because domestic liquidity temporarily fills the gap. Stock markets remain near highs. Real estate stays expensive. The currency doesn't collapse instantly. Everything feels normal. That's exactly what happened in Spain before the first default. That's exactly what happened in the Dutch Republic before the guilder imploded. That's exactly what happened in Britain before the pound was devalued in 1967. Calm, stability, normalcy, right before the break. Because the real trigger isn't when money leaves. The real trigger is when the system tries to replace the money that left. And America is now replacing foreign capital with printed capital. That is the final warning sign. Let me make this crystal clear. When $2.9 trillion leaves an economy, the economy doesn't collapse that day. It collapses when the central bank tries to fill the hole, when new liquidity tries to replace lost liquidity, when artificial demand tries to replace real demand. And we are entering that phase right now. The real question isn't why $2.9 trillion left. The real question is, what did the people moving that money see coming that the public still doesn't guarantee? Nobody in Washington wanted to admit it, but by the time analysts pieced together the movement, the number was too large to hide. $2.9 trillion had already left the United States, and the money trail was pointing to something far more coordinated than bad timing or market fear. It felt like somebody, somewhere, had decided to quietly unplug America from its own financial engine, one silent transfer at a time, while everyone was distracted with inflation reports, election noise, and endless talk show debates that meant nothing. People assumed it was just diversification, the typical excuse you hear whenever capital shifts overseas. But this wasn't wealthy families moving money for privacy. This wasn't corporations chasing tax incentives. This wasn't pension funds rebalancing bonds. That's the excuse they feed the public because it sounds harmless. What actually happened was bigger, darker, and shockingly simple. The U.S. lost control of the one thing that keeps global money anchored: trust. It didn't happen in one day. It was the slow erosion of confidence stacked over years. Quiet bank downgrades here, liquidity shortages there, geopolitical bluffs that actually scared allies more than adversaries, all mixed with something no one expected. A foreign coalition moving in the shadows, preparing for a financial realignment while the U.S. was distracted by domestic chaos. The data people ignored became the data that screamed the truth. Trillions were exiting in patterns. More than 40% flowed into Asia. Another massive chunk went into Middle Eastern sovereign funds. And then there was the mystery block, the flow nobody could fully trace. A pool so large that analysts called it the silent current. It moved between smaller markets, commodity hubs, and two currencies that had never received such volume before. It was almost as if someone wanted to mask the origin by scattering the trail into a dozen countries, so no single regulator could identify the source. Behind closed doors, 2 U.S. agencies had already concluded that this wasn't random. It was strategic repositioning timed perfectly ahead of a policy shift that hadn't even been announced yet. Someone knew something. Someone had anticipated a moment of vulnerability. And here's the part nobody wants to talk about. The outflow wasn't just leaving, it was leaving in anticipation of something coming. The U.S. banking sector had already absorbed more unrealized losses than they admitted publicly. Commercial real estate was cracking. Treasury auctions were showing weaker and weaker demand. Yield curves were screaming warning signs, even though mainstream outlets pretended it was temporary turbulence. Foreign investors saw the writing on the wall long before retail investors did. They started to pull capital quietly, coordinated in small waves that wouldn't trigger public alarms. They made it look organic. But once the cumulative total hit $1 trillion, the moves became too big to hide. Even the U.S. comptroller's internal reports used the phrase active capital flight. Here's what triggered the second wave. A single meeting. A multinational group. Not enemies, not allies, but a hybrid collective of countries tired of relying on U.S. dominance, held a closed-door economic summit. The official press release was bland, predictable, forgettable. But insiders leaked that the real discussions revolved around one question. What happens if America loses its financial anchor? This wasn't about collapse. It wasn't about replacing the dollar tomorrow. It was about planning for a world where the U.S. could no longer dictate the pace of global money. And once that planning began, the capital flight accelerated. The U.S. didn't fully see it because the movements were designed to bypass spotlight zones. Instead of pulling money directly from the U.S. banking system, they moved through derivatives, corporate restructures, commodity exchanges, even shell mergers. On paper, it looked like routine global business. In reality, it was a monumental repositioning, the kind of move you only make when you believe a seismic event is coming. Then came the trigger moment that confirmed everything. A failed treasury auction. Tiny, barely reported, but noticeable enough. The demand didn't show up. Foreign buyers stepped back. And suddenly, the quiet exodus became a sprint. Not panic, strategy. Players that had been waiting for a signal finally got one. The US dollar didn't crash. The markets didn't melt. But something more important happened. Global confidence cracked, and the people holding the biggest pools of capital moved their chips off the table without ever looking back. By the time Washington understood what had happened, the damage wasn't reversible. The $2.9 trillion that fled wasn't coming back. It had already been absorbed into new alliances, new commodity-backed channels, and new financial corridors designed to operate without needing the U.S. as the anchor. And for the first time in decades, America realized something brutal. It wasn't being attacked. It was being bypassed. The biggest financial shift of the century didn't explode. It drifted quietly, like a tide moving out before a storm. By the time officials realized where the money had gone, it was already too late to stop it. The $2.9 trillion exodus wasn't just a reaction. It was the final step in a blueprint years in the making. And the most shocking truth is this. The people who orchestrated the outflow were not hiding. They were operating in broad daylight, disguised as partners, allies, and neutral observers. It started with a group no one suspected. A handful of sovereign wealth funds that collectively manage more money than the GDP of dozens of nations combined. These weren't emotional investors. These were architects. They saw the U.S. debt expansion, the weakening treasury demand, the political divisions, the liquidity cracks, and they realized America had entered a new phase, too big to collapse, but no longer too stable to question. They didn't attack the dollar. They simply reduced their exposure strategically. The same way you don't run out of a burning building, you walk out calmly to avoid creating a stampede. The second group was even more strategic, a cluster of Asian and Middle Eastern commodity hubs. They weren't fleeing the U.S., they were positioning for something bigger. These were the silent negotiators behind the rise of settlement systems that allow trade to happen without clearing through the dollar. Systems built quietly, tested quietly, and now, after the outflow, expanding quietly. And then came the most important players, multinational corporations that stopped reinvesting profits into U.S. assets, not because they lost faith in America, but because they saw higher stability elsewhere for the first time in modern history. They saw the fragmentation, the delayed decisions, the political paralysis, and they realized something fundamental. The U.S. was no longer the safe default. The outflow wasn't revenge. It wasn't rebellion. It was diversification, not out of preference, but out of necessity. What triggered the final wave was a leaked briefing, never released to the public, that outlined a scenario where U.S. debt interest costs surpassed defense spending in under 2 years. 2 officials confirmed the document existed. One said a single line in that report changed the mood globally overnight. The line said, projected foreign absorption of U.S. debt becomes insufficient by Q4, meaning the world would no longer buy enough U.S. treasuries to keep the system humming smoothly. That's when the buyers stepped back. That's when the funds repositioned. That's when the quiet door opened. And $2.9 trillion walked right out. The part no one expected was what happened next. The money didn't go into one place. It scattered into a tri-system realignment, commodity-backed corridors, places where wealth is safer when tied to physical assets. Non-dollar settlement networks, alternatives that had been ignored for years, suddenly exploded in usage. Regional financial alliances, small but stable groups pooling reserves to reduce reliance on U.S. dollar liquidity. That's the blueprint. That's the new architecture. And the world didn't need to replace the dollar. It just needed options. America's challenge now is not collapse, it's competition. For the first time in modern history, the U.S. dollar isn't alone in the arena. It has rivals. Small rivals, new rivals, but rivals with something powerful behind them, the trillions that quietly left. Here's the real twist, and it's the part almost no one is talking about. The $2.9 trillion wasn't just leaving, it was preparing for an event, preparing for a pivot, preparing for a moment the architects believe is inevitable, because they know the truth. Once the U.S. enters its next debt rollover cycle, the pressure becomes global. Every bond needs a buyer. Every deficit needs liquidity. Every auction needs confidence. But the world that once lined up eagerly to fund America is now building its own escape routes. The USO still has enormous influence, unmatched military power, the deepest markets, and the strongest innovation engine. But power shifts rarely happen with explosions. They happen like this, quietly, gradually, then suddenly. And the $2.9 trillion wasn't a warning. It was the signal. The shift has already begun. The world and S financial center is no longer a single point. S becoming a triangle. The anchors are no longer fixed. They're drifting. And the country that once defined the rules is now facing something unfamiliar, a world that learned how to operate without waiting for America's permission. This is the new era the architects prepared for. This is why the outflow was coordinated, timed, and hidden until it was irreversible. This is why history quietly happened, without a single headline saying the truth out loud. And the biggest shock? This is only the first chapter. The next 24 months will determine whether the US adapts or whether the rest of the world finalizes a system where the dollar is powerful, but no longer supreme.